Good morning.
Good morning,
Well,
Professor.
I'm just, oh, what happened? I just didn't know what time it was. I was reviewing our last session, and then I just got carried away. I just kept. So, were there more people here? Were there more
Um,
people? No?
no, it was just Anna that she
Oh,
left.
okay. Jesus. I was just, I just totally, got carried away. I was just reviewing our last class, and then I thought I still had time. What's happening? By the way, I mean, I have only 5 people, and let me share. Let me share this application. Okay, and then it looks like. Okay, by the way, everyone is aware, right? By the way, uh, have you guys noticed that quiz one was assigned, right? Oh, why is it not available? Oh, Friday, March 11th. Oh, tomorrow. Okay. I don't know why in some other class. Okay, this announcement will go out tomorrow, actually. Why did I think it was already posted? So there will be quiz one on the 18th, right? This is not there yet. I don't know why another class, some other class, it already went out. Did it go out? Or no. 1500. Oops. Section 1500. Let's see. Come on. Okay, this is section 1500. Here. Okay, go away. Why is it doing this? Okay. That's weird. Even in section 1500, this was scheduled to go out tomorrow, but some students already knew that. That is weird. But anyway, something, just heads up, and then discussion board. Let me check. Uh, things are not okay. So page 2. Yeah, March 10th. Yeah. Oh, what's happening? Something's. Oh, so. Oh, okay. Okay. This actually, the date is. Okay, I guess I need to. All right. Oh, what's going on? Oh, uh, Okay, the rest of it is like, mm, okay, looks like it was all messed up. So I see 7 people somehow. What's going on? This is a class of at least like 20, at least 20 something. I have only like all right. So it looks like a lot of people are um, signing in very late, and I see only 5 people here. Now this is a problem. If you are for your information, in 1 hour session, if you are late by more than 10 minutes, you are late. Okay. And in 2 hour session, 2 hour session, um, if you are more than 20 minutes late, you are late. But this is 1 hour session. So if you are more than 10 minutes late, you will be marked as late. Okay. So, uh, now, so in our last class, we already started talking about the balance sheet, but actually it's nothing new because the balance sheet, we've been also, although we started out with the income statement, the balance sheet was also, it was inevitable to also uh, mention balance sheet because in the income statement, when it comes to the interest is, why do we, where does it come from? I mean, why does the interest payment arise? I mean, from where does it arise? It's only obvious that the interest rate, I mean, we have to pay interest because we have debt. If you don't have any debt, Tuesday 12, this is yours. So the company has debt. That's why we have interest, right? If the company didn't have any debt, there will be no interest. So we had to talk about, then uh, uh, capital structure, right? That inevitably, the fact that we have debt, and it's because uh, we needed uh, capital, startup capital, right? We needed startup capital uh, uh, to build the plant and install the equipment in the plant. So the startup capital came from equity and debt. So that's why we have, right? That's why we have, debt, and we have to pay interest, right? And that brought us to the uh, capital structure. Depending on, how much of, so so we needed, a total of $100 million, right? We needed, a total of $100 million, right? That's called total assets, right? Ah, 100 million, right? But this 100 million 40% came from debt, right? In other words, 40 million came from debt, uh, and 60 million came from equity, right? So the composition of equity and debt is 60% and 40%. And I told you that's what they call capital structure. And the reason you need $100 million to start up, it's because you need at least 90 million to build the plant and put equipment into it, right? So uh, so think about it. This 90 million, I mean, in the income statement, you remember what was called sunk cost, right? Remember what was called sunk cost? Actually, so this, 90 million, this 90 million is the sunk cost, right? That's the initial investment, right? Now, so if we look at, and I told you, uh, assets are defined on three levels, right? One, we know asset in accounting, they define assets as what you own and liabilities as what you owe. And what about then equity? Equity is what you own free of debt, but then um, it's going to be, um, as I said, it depends on, whose perspective, right? Once again, when we define you, just habitually and customarily say you, you own or you owe, but who is you here? Mhm. And I always say, of course, in the English language, right? You can mean, second person, right? You can mean second person. Um, or you can also mean, uh, people in general, right? It's generic pronoun, you, right? Um, so it becomes very confusing. It becomes very unclear if we use you as, generic you, generic pronoun, right? Now, but think about it. Uh, in this case, you can mean the owners of the company, the shareholders. Of course, from the shareholder, because shareholders own the company, right? But then from the shareholders' perspective, assets, yeah, that's what they own. Liabilities, yes, that's what they owe. Um, Especially if it is the sole proprietorship, if it is the sole proprietorship, right? The owner, I mean, company's debt is the owner's debt, right? Uh, and uh, equity is what the owners own. So uh, it's clear, what is who owns what and who owes what. Now, but then you can also look at it from the company's perspective. And once again, company is not an animate entity. I've been telling you over and over. Company is just a vehicle to funnel the profit to the owners, right? So from the company's perspective, in other words, from that, uh, uh, legal entity's perspective, right? From the company's perspective, yeah, assets are what the company owns. Liabilities are what the company owes, and equity is what the company owes to the owners, the shareholders, right? So now this picture, uh, own versus owe, right? Uh, the liabilities and equity side, is completely uh, uh, what is owed by the company, right? Now, uh, so you also understand that this side, asset side, is basically use of the capital, right? First, the right side, the liabilities and equity side, that's where the capital came from, right? In other words, source of K, source. Okay. I hate to write. Why? What's happening? Okay, the eraser isn't working. Oh. Source of the capital, or where capital came from. And the asset side shows, the use of the capital. Ah, okay. So the asset side shows the use of the capital, right? So source of the capital, the liabilities and equity, right? Where the capital came from, and use of the capital means how the capital is held. Okay, in what form is the capital held? Right? That's what it means, right? Okay. Um, so with this clear understanding, you need to have this clear understanding. Um, Otherwise, it can be, it's very important to um, instill this, clearly, organize and, summarize this and instill it in your mind. Uh, that's the only way you can do well in, financial statements. And a lot of, basically, this is almost 90% of the financial accounting, right? In financial accounting, if you master this, um, uh, the basic, relationships between these, statements and uh, how they are connected, uh, then, you will have a pretty firm, uh, uh, you will have a pretty firm grip on, financial accounting. So, and then second, we know assets are liabilities plus equity, and that's, called accounting equation. And three, assets, this is probably the most important most important aspect of assets. Assets must have income generating power. Assets must generate income, right? Uh, if it cannot generate income, it's not an asset, or it has, zero asset value. For example, if you can have 100 square feet of land, right? If you can have 100 square feet of land, what's 100 square feet? 100 square feet is, 10 feet by 10 feet, right? That's 100 square feet. But if you can have this 100 square feet of land, let's say you have two choices, either in Midtown Manhattan or in the middle of Nevada. Middle of Nevada. Where would you have? Where would you have this 100 square feet of land?
I'd go with Midtown Manhattan.
Yeah, of course, Midtown Manhattan. Anyone with any sensibility would have it in the Midtown Manhattan. Why? Because of the asset value, the income generating potential. Because if you have 100 square feet in Manhattan, 100 square feet is not that big. It's just 10 feet by 10 feet, and probably, but with this empty lot, at least you can park cars there. It can be used as a parking lot. Of course, maybe three minis, at best, three minis will fit in there. I don't know. Either way, I mean, it's a square, right? It's a square. I mean, either way, it will have to, three minis will have to fit in there, right? And it generates income. But in the middle of Nevada, there's no income generating potential. The asset value, of course, because it's the income generating potential, right? And if you build a 10-story parking structure, right, your income, it generates income, right? Income will be, 10 times, right? So you can easily recover. You can easily recover the cost, the initial investment of building a 10-story parking structure. Now that's why next, then if you look at the asset side of the balance sheet, of course, it consists of non-current assets and current assets. Of course, non-current assets are we already know it's physical assets or real assets or fixed assets, right? Goes by different other names. Of course, plant and equipment, right? That plant and equipment, that's $90 million, that cost you $90 million to build it, right? And then, building and land, and depreciation is a negative number. Here, I didn't put any depreciation there, but, plant and equipment, building, they all depreciate with age. Think about it. As time goes on, the value has to go down because everything wears and tears with time, right? Land doesn't depreciate. The only thing that doesn't depreciate is the land. Okay, and then the other The remaining 10 million is called current assets, and current assets are also called working capital, right? It's generally all of these things are called, working capital. Where should I put it? Hard to. I'm not going to write it there because it's going to ruin everything.
You put there, Professor, liquid asset. It's the same.
Yeah. Because it's same thing. It's the same thing.
Yes.
But I want to put, working capital somewhere, and it's going to ruin everything. Let me just get rid of that and probably. And then okay. Liquid assets, current assets, working capital. Now think about it. You need working capital to keep the company running, right? While the plant is still being built, right? Although the plant has not been completed, but the company needs to, although it's not completed yet, the company needs to operate. In other words, they cannot make anything yet. They cannot sell anything yet, but at least you need to keep it going. You need to have, and in the meantime, you have to you need to keep the company, running, right? The administrative staff, clerical staff, they need to come to work. I mean, during the time when they don't have any revenue, the company still needs to operate, right? So that's what working capital is. But working capital can break down into its components, right? Several components. First, cash and cash equivalents. Cash and all these line items are listed in the order of liquidity. And you know what liquidity is because we already discussed that in topic 1. Of course, it's defined on 3 levels. The most basic level, liquidity means how easily any asset can be converted into cash, right? On the second level, it means cash flow. Third level, it means money supply, right? On macroeconomic level, it means money supply. Now, so cash is already cash, so it's the most liquid asset, right? Cash equivalents are very short-term assets, so that they are very short-term instruments, so that they are very safe. No risk of losing value due to inflation or anything. So they are called cash equivalents. And to find more about cash equivalents, you can go to right. It's in the course materials, right? I put a link there, and then you can find more about it. Okay.
I have a question.
Yeah.
So would cash equivalents be like would time take into effect like a CD that or like a bond, would that still be.
Yeah. Look, but as you mentioned, time is a very important factor, right? Because um, if it is long term, right, it cannot be cash equivalent. If it is long term, um, there's a chance the value can be affected by inflation. You check this out,
Oh,
okay? I don't know if you can hear the
Cash
audio.
and cash equivalents are items on a company's balance sheet that are either physical currency or liquid investments that can be immediately converted into cash.
Can you hear the audio?
we can hear
Yes.
it, yeah.
Okay,
Examples
then
include
keep
bank
listening.
accounts, marketable securities with short-term maturities, treasury bills, and money market funds. They are unrestricted, meaning they can be turned into cash with little trouble or delay. Unlike investments such as stock, cash and cash equivalents don't typically change in value very much. They represent a company's liquidity and reveal aspects of a company's operational strategy, both important details for potential investors to consider. Companies use cash to pay debts. The more cash a business has on hand, the less likely it is to struggle to pay its short-term liabilities or to have difficulty staying afloat when sales slow. But it's also important to remember that a company with large amounts of cash on hand may be missing out on the money it could make by investing that cash.
Okay, you heard that. So, this is my favorite site. Uh, um, so, cash equivalents, time has a very important uh, element. Time is a very important factor on the cash equivalents because remember from the topic one, uh, among the risks, right? Among the risks in bonds, right? You remember default risk is the greatest risk. Of course, it goes without saying when you're lending money default. And then inflation risk, right? It affects every asset in the market all in the same way, right? And then there's also, liquidity risk, and there was also maturity risk. Think about it. Maturity risk is what? It's the risk associated with time, right? Why? Because over time, most of all, interest rate can change. Interest rates can prevailing market rates can change. And if the prevailing market rate goes up, that's not a good thing because the valuation goes down. Valuation of the bond that you're holding is going down. So think about it. Um, cash equivalents are the short-term bonds like treasury bills, right? Very short-term, like 3 months, right? 1 month, 3 months, because within 1 month or 3 months, there's hardly a chance of interest rate fluctuating, market rate fluctuating within that short-term period, right? And even if it is going to change, then it is, within the very short term. So everything is already predicted, and then uh, uh, the the current valuation, the valuation of short-term assets may change, but because it is short-term, you're not going to sell it. You hold it only for 1 month or 3 months. So even if the prevailing market rate changes, you still get right. You still get what was promised, and then it's only the inflation that would matter. But you can, as I said before, anything in the short term is well, can be uh, already predicted and priced in already in the valuation. Okay. So next is so it's a very short-term equipment, a short-term instrument, and the next thing is marketable securities. Marketable securities means stocks and bonds. So generally long-term. These are long-term, and then promissory notes and accounts receivable. Now, before promissory notes and accounts receivable, let me talk about the inventory first, brief. Inventory uh, for inventory is basically raw material, right? Raw material and goods in process and finished goods for the manufacturer, right? But for the retail, it's the finished goods. So think about it. If you're a manufacturer, right? You have to, this is the production process, right? And you have raw material, right? Raw material goes into the production process and comes out the finished goods. Right? And while it is still in the process, is called goods in process or work in progress. Think about it. What else can it be called? I mean, they mean the same thing, goods in process or work in progress, right? Or otherwise, you can also paraphrase it as, like half assembled state, half assembled, or partially assembled state, right? But you understand, it costs money to buy raw materials. So where does that money come from? From working capital, right? Part of the working capital turns into raw material because you purchase, with $10,000, you $50,000, you buy raw material. So inventory of raw material is very important for a manufacturer, right? Because if your production increases, right, raw material must also increase. The more raw material you have, that means you have a bigger production plan. Okay, you have a bigger production schedule, and so dollar value of this must be monitored, right? It needs to be checked so that your precious working capital won't be wasted. And then when it goes into the production process, so while it is in goods in process state, then it's hard to put a dollar value on it, right? Because it should be more than raw material, but actually while it's in goods in process, while it's in that state, the dollar value would be not much more than the raw material value. When it is finished goods, the dollar value will be much greater than the raw material dollar value. Isn't that right? Why? Finished goods, the value has been added, right? Finished goods have value added, right? Value
Yeah.
added to the raw material. So it's like, when they say, the whole is greater than the sum of the parts, that's exactly what it means, right? The whole is greater than sum of the parts. I mean, just because you assemble, you put together the raw material, it doesn't turn into a computer. It must be assembled in a certain way. And the finished computer is, much more valuable, right, than the parts and components because there is added value, right? Now, so we know by tracking the raw material value, because obviously some of our working capital turns into raw material and it turns into finished goods. And then what kind of dollar value do we put on the goods in process? It's kind of questionable, but it should be at least equal to raw material value. I mean, while it is just half processed, it cannot be sold. It's just half processed, so half assembled. You cannot really put a certain value on it, but at least it should be equal to at least equal to raw material value. Well, I guess that's all the time we have for now. So I'll have to call it a day. Any questions so far? Any questions? Any questions? All right. If you don't have any questions, have a great afternoon. Have a great day, and I will see you guys on Monday, Tuesday, right? I'll see you guys on Tuesday.
Yep.
All righty. I'm just sorry for missing the early part, and I hope to see more people Tuesday, because this is, this is terrible. I mean, we have 20-something people on the roster. Not even half is here. What happened to the other? Are they just simply lazy or just too laid back? All righty. So have a great day. I'll stop sharing and stop recording, and